Good morning in America, good evening in Singapore, and good afternoon here in Switzerland. A very warm welcome to today's broadcast, our conversation with Jim Rogers. My name is Mark Dittli. I'm the editor of The Market based in Zurich. It's my great privilege and honor to be your moderator today. We are joined by Jim Rogers and by Felix Zulauf. And over the next hour, we will talk about what's happening in the world and in world financial markets. It's my great pleasure to introduce Jim Rogers. You all know him. He's a best-selling author and adventurer, and obviously a successful international investor. Jim grew up in Alabama, and as per his own account, he started in business at the age of 5, selling peanuts. After attending Yale and Oxford universities, Jim co-founded the Quantum Fund together with George Soros in 1973. From that year until 1980, the portfolio of the fund gained 4,200%, while the S&P rose less than 50%. Jim then decided to retire at the age of 37. Continuing to manage his own portfolio, Jim kept busy serving as a full professor of finance at the Columbia University Graduate School of Business. In 1990, Jim fulfilled his lifelong dream, motorcycling 100,000 miles across 6 continents, a feat that landed him in the Guinness Book of World Records. As a private investor, he constantly analyzed the countries through which he traveled for investment ideas, and he chronicled this one-of-a-kind journey in the book Investment Biker: On the Road with Jim Rogers. In 1998, Jim founded the Rogers International Commodity Index, a broad index of commodity futures, which since 2007, the index and its 3 sub-indexes on agriculture, energy, and metals are traded as exchange-traded products. From 1999 to 2002, Jim did another Guinness Book World Record journey through 116 countries, covering 245,000 kilometers with his wife, Paige Parker, in a custom-made Mercedes this time. And he recounted this journey in the book Adventure Capitalist: The Ultimate Road Trip. He subsequently published more books, among them Hot Commodities: How Anyone Can Invest Profitably in the World's Best Market, A Bull in China, A Gift to My Children, and Street Smart's Adventures on the Road and in the Market. Jim joins us from Singapore. Jim, welcome. It's great to have you on the show today. And we're obviously also joined by Felix Zulauf. You all know him. Zulauf Consulting offers proprietary global macro research covering a wide variety of topics such as equities, fixed income, credit markets, currencies, commodities, and geopolitical themes. I'd like to first ask Jim to maybe take 5-10 minutes max to give us your big picture view of the world as you see it today, your big picture view of world financial markets. Then afterwards, I'll invite Felix as well, and then we'll have a discussion. And at this point, I'll also invite you from the audience to, whenever you have a question, just type it into the chat box, which you can see on the right side of your screen. But now, over to you, Jim.
Well, thank you very, very much. Mark, you left off the fact that everything I know, I learned from Felix Zulauf. So I'm very pleased to be here. I'm very, very, very pleased to be here. And I'm sure I will learn from him yet again. Big picture. Let's see, as I look around the world, bonds, as I look at asset classes, bonds are obviously in a bubble. We have never had such high prices for bonds in the history of the world, and that's nearly every country in the world. So bonds are certainly in a bubble. If you look at property, well, many cities, Seoul, New Zealand, countries, etc., property is certainly in a bubble in many places. Not everywhere. I mean, prices are coming down sharply in some cities. If we look at stocks, you can certainly see that stocks are beginning to form bubbles in some countries. Amazon, Tencent, Samsung, these stocks never go down. So we don't have a serious bubble in stocks yet, because many stocks don't go down. I mean, many stocks are not up. They're not participating in this, but you can I anyway can see bonds of stocks beginning to form a bubble. You know, all the signs are there. We have lots of new people coming into the market, suddenly discovering how easy this is and how much fun it is to make money so fast. So we have new signs. You know, if you go to the dentist and the receptionist wants to talk to you about stocks, you know, that sort of thing is starting to happen again. Bubbles have always been the same all over the world throughout history. So stocks are beginning to form a bubble. The cheapest asset class I know is commodities. I mean, silver is down 50% from its all-time high. You know, sugar is down enormously from its all-time high. So if you look at commodities, oil is down over 50% from its all-time high. So as I look around the world, there are opportunities everywhere. I bought some stocks recently, but I think the cheapest asset class at the moment happens to be commodities. Now, I can go on and on, Mark, but let's stop. Let's the party proceed.
That's great. Thank you very much, Jim. Over to you, Felix. How do you see the world, and how do you see world financial markets today?
Well, my approach from a macro point of view is that we have seen a major change in policy setting. Since 2009, authorities in the Western world used gigantic liquidity creation and injection into the banking system to create growth, economic growth, which didn't really work in the real world, but it worked for the asset world. We see lockdown, pandemic-induced lockdown, the policy setting change, because now they are now using fiscal stimulus combined with monetary stimulus. I think that's a big change from the past 10 years. And I think this change is going to last for several more years into the future. So this will work in the short term, it will work, and it can put economic growth beyond, above the long-term trend growth. But long-term trend growth is coming down, and as soon as the push is lower than the year before, growth rates will drop back down again. So I think the next few years is very bullish for commodities. It's still bullish for equities, it's bearish for stocks, and it's bearish for the US dollar in the long term. That means in the next 5 years or so. The US dollar has probably started a secular bear market in early 2020, and it has completed its first down leg early this year. And what we now see for the rest of the year is a correction to the upside, which will be very irrational, very erratic. And I think the first up leg is already complete. And into mid-year, we see a softer dollar, followed by a stronger dollar in the second half, triggered by a further rise in bond yield and widening yield gap between the US, in favor of the US, to other markets in Asia and in Europe in particular. So I think the next few years will be a trading market, because we are back into a stop and go through fiscal policies and monetary policies. Right now, we have the highest sentiment numbers we have seen in some years in stock markets. And this is a warning sign that we should see some sort of correction. I think May will probably bring on a correction. If it is as shallow as the correction that was rotational in March, I think we may go higher. Cycles would suggest a high in summer, followed by the deepest correction this year, probably beyond 10% in the major averages, before we run up again early next year.
Okay, thank you very much, Felix. I'd like to start our discussion before we move to financial markets, just a little bit on the geopolitical level. Felix, in one of your latest reports, you wrote that you see a serious new Cold War beginning between the US and China. Obviously, we have a new administration in the US. Since January, we've had the first meeting in Anchorage a couple of weeks ago. But Felix, you see a clear danger of a serious new Cold War between those two superpowers. Jim, I'd like to hear from you. How do you see that, and how do you see that playing out from your vantage point in Singapore?
Well, Mark, throughout history, when countries have problems, the politicians blame foreigners. They love to blame the foreigners. It's very easy to blame foreigners. They have different skin, different languages, different food, different religion, different everything. So throughout history, all over the world, people blame foreigners, and that's happening again. The Republicans had problems and they wanted to blame China to win the election, and the Democrats had problems. So both of them outright said we're going to blame China, and they did. Unfortunately, even with the new administration, you know, there's a big hangover, because for several years, Washington and American politicians were banging China, banging China, banging China. So that's hard to go away. And unfortunately, China is the biggest and the most successful right now, so there's going to be more of it. China has been more restrained than the U.S. I hate to say. I am an American, so I don't particularly like the way I see American politicians acting. But Mark, this is the way these guys work. You know, they always find somebody to blame. They never blame themselves. They love to blame big visible enemies. And I'm afraid it's going to get worse. It doesn't have to. Throughout history, countries have worked together and prospered together and succeeded together, but then it's also often led to war, real war, not just trade war, shooting war. I'm afraid that I'm not terribly optimistic about the next couple of decades in the world, because I know what history shows and I know what politicians do. And Mark, I guess the main lesson of history is people don't learn the lessons of history. If they would just read history, we could solve a lot of these problems, but that's not, they don't, you know, the recent president in the United States, Mr. Trump, I don't think he knew history, but even if he knew history, he thought he was smarter than history. He didn't have to worry about history. He's smarter than history. Well, unfortunately, I know history is certainly smarter than me and smarter than all of us.
On that topic, and those are a couple of the questions that were handed in to us from some of the people who are in the audience now. Obviously, a lot of worries circle around Taiwan. And given the fact that we have a new administration in Washington, and kind of we're in this phase where Beijing, just as Moscow is doing, are kind of testing the resolve of the new US president. What do you see, or how do you see, Jim, the issue of Taiwan playing out sort of in the shorter term and also in the medium term?
Well, it's part of the same game. The American politicians raised the issue of Taiwan again. Mr. Trump was shrieking and yelling and doing everything he could to raise the issue of Taiwan to antagonize China. Does it have to be that way? No. China and Taiwan can coexist. And looking at Chinese history, you know, they're more patient than most of us. They'll wait 100 years if they have to get Taiwan back. I don't see any reason for war, but unfortunately, at the moment anyway, under Mr. Trump and others, they've raised the issue and they're forcing the issue. There is absolutely no reason for it. If you look and you see them, there are millions of Taiwanese in China now, investing and in business, many in schools, etc. There's a lot of interchange between the two. It could continue that way, but unfortunately, America's looking for reasons to antagonize people and to divert attention. That's one of many issues. America keeps bringing up these issues. I'm not saying the Chinese don't make mistakes. Don't get me wrong about this. But since you brought up Taiwan, that's one that America's doing its best to antagonize China.
Felix, what do you hear about that topic?
Well, obviously, the Taiwanese elected an anti-integration government. The current government is very anti-integration. China sees Taiwan as a renegade province that has to be brought home. It's true what Jim says, the Chinese have more patience than others, but they said in a treaty with Great Britain that they would wait another 47 years or what with Hong Kong, and it just took a couple of years and they integrated it. You know, it can all change. If the opportunity is there, it can all change. It's obvious that China believes this is China's business and they do not want anybody to mess up with them and interfere because it's their own business. I do believe that China is going to test the new US administration. There will be some saber rattling in Taiwan, as there is by the Russians in the Ukraine going on right now. That's another testing of the Biden, of the new administration. But I do not believe that it will lead to a invasion by China within the next 4 years or so. Even so, I consider Biden most likely a weak president when it comes to foreign policy, on the order of Obama and Jimmy Carter and so on. I do not believe that it will come to an invasion. Of course, if the US wants to pull up the heat a little bit further, they could, like the Russians did in Cuba, they could station some missiles on the Taiwanese island, etc., etc. But that would lead to further escalation, and I think at the present time that's not in store. So I think it's not serious yet. It's some saber rattling, and the two countries will remain separate for the time being.
Mark, the danger is that the danger is that as economies get bad, again, people like to blame foreigners, and saber rattling or war is a great diversion from problems at home. I mean, this is a simple lesson of history all over the world. Politicians love to saber rattle, cause problems, and blame the foreigners. And Felix is right. That may well be, Taiwan may well be one of those places that the American economy gets bad again. When and if it gets bad again, they'll raise the stakes of it many places that they can.
Right. When we move to markets now, Felix, in your introductory remarks, you mentioned the importance of fiscal policy that we're seeing today. Now, what's interesting to see is compared to post-global financial crisis a little more than 10 years ago, it seems like the US and China have swapped chairs. Today, it's the US that is stimulating heavily, both fiscally and monetary, while China is on a tightening path. And given that, we have seen a dollar appreciating and we have seen bond yields in the US rising. Jim, you first. How do you see that playing out? Are we only at the beginning of a phase of rising bond yields in the US?
If you're asking me, well, you know, American bonds have been in a bull market for 40 years, since 1981. By the way, for what it's worth, it was a 40-year bear market before that until 1981. That I think is just coincidence, but we've had a 40-year bull market in bonds in the U.S. I suspect that bond market has come to an end. I mean, bottoms don't happen in one day or 1 week, but I'm sure that over the next few years, you're going to see rising interest rates, not just in the US, but all over the world. As I said before, bonds have never been this expensive in the history of the world. And likewise, debt. I mean, America's the largest debtor nation in world history, and the debts are going higher and higher, but that's happening all over the world. As you have more and more supply of bonds, there are many reasons that bonds can enter a bear market, including the prospect of higher inflation, as all of this money printing eventually leads to higher prices for various and sundry things. There already are higher prices in many things, Mark. I don't know if you do any shopping, but for those of us who go out, we know that prices are higher and higher. You know, I know Felix has his butler do his shopping, so Felix doesn't know. But the rest of us who do shopping or go to restaurants or whatever, we know that prices are higher and higher. Governments lie about it. They have many reasons to lie about it, and many reasons to lie about many things. But we're certainly going to have inflation. We have gigantic supply of bonds, so interest rates will be going higher over the next few years. Not every month, but they'll be going higher.
Felix, you agree with that? If I understand your views correctly, you see that we're at the beginning of a longer trend of rising bond yields in the US.
Yes, it will. But I think it will be a slow process, and it will go in steps. One of the reasons is that the demand side of the economy will be boosted by government spending, and governments are spending like there is no tomorrow. Last year the U.S. deficit run as high as in World War II. That is unprecedented in peace times. They doubled up this year by adding another spending program of $4 trillion, which is huge. And obviously, it's all going to be financed by debt. So there will be as much debt as sand on the beach. It's unbelievable. That is one thing. The other thing is that if I'm right, that the Cold War is getting more intense over coming years, it means that supply chains will be more lined up according to safety of delivery and not according to profit maximization or cost efficiency. And that also leads to some deglobalization, and deglobalization means that we have a less efficient world economy, which makes prices go up and profits go down or up less than it would be otherwise. And therefore, this is an additional point for rising inflation over time, and therefore rising interest rates at the long end. For a while, central banks may try to control the long end of the bond market. They can control the short end, no question about that. But they cannot control the long end forever. They control it for a certain period of time, but over time, markets are more powerful than central banks. And therefore, I believe, as Jim does, that we will see rising interest rates over the next 10 years. Yes.
So basically, you both say you see inflation rising over the coming years. You see bond yields rising over the coming years. Now, in the shorter term, let's say the next 2 to 3 years, isn't that exactly what central banks want? Central banks want finally to get inflation up to 2%, or the Fed even wants it to get up to 2% plus. Will they be able to control that nicely, Jim?
Well, that's what they say, Mark. Yes, but I mean, you have to remember, they don't know what they're doing. These guys are bureaucrats and academics. They don't have a clue what's going on in the world or how the world works, and they listen to each other, and it gets worse and worse and worse. No, I mean, the real world, inflation is not good, whether it's 2% or whatever, especially since it always gets out of control and it goes higher and higher. They say they want it. Will they be able to control it? Rarely in history have they been able to control it without a crisis or a semi-crisis. So no, I mean, I cannot remember, there haven't been very many sound central bankers in my lifetime, and I haven't read about many before my lifetime. So no, I don't put much confidence in these guys. And Mark, remember, it's only been in the last few decades that anybody even knew who the central bankers were. Now they're all rock stars. Everybody knew who Alan Greenspan was, blah, blah, blah. Everybody knows who these people are now. But remember, throughout history, nobody had a clue, rightly so, because they don't know what they're doing and they always make mistakes.
But let me interrupt here briefly. Basically, when I look at the topic of inflation, 12 years ago, after the global financial crisis, after they introduced quantitative easing and so on, many people warned this will be inflationary. Now, from that perspective, inflation has been a dog that has barked, but it has never bitten in the last 12 years. Why should it be different this time? the question is to both of you, but maybe Felix, for you first. Why is it different this time?
Well, first of all, they do not measure inflation properly. That's the one thing. They measure whatever suits them well, and they have changed the basket of the consumer goods they put into the basket and measure it as inflation every few years. And therefore, if you took the basket of 1980, the inflation rate right now would probably be around 6 or 7% or so. So it's the changes that they make that distorts the statistics, so to speak. And secondly, we have had the most powerful deflationary force when China was integrated into the world economy. That was a tremendous deflationary force, and they became the cheapest producer at the margin for all sorts of consumer goods. And that has creeped into our CPI inflation due to negative 1% import inflation per year over the last 30 years. And import inflation is about 1/3 of our CPI measured inflation. So I think this has been a powerful deflationary force that kept the statistical inflation rates low. If I'm right and we see some deglobalization and the Cold War intensifies, then we have a change. And I do believe that the Chinese are changing their behavior. They didn't go for maximizing profits, the companies. They went for maximizing employment, like the Japanese did in the 1980s. And I think they are changing because they realized they have weak balance sheets. On average, the Chinese companies have weak balance sheets, and they need to work on those balance sheets, and they need higher profits. And therefore, I think they are going to raise export prices. And if that is right, then you have a swing factor of a negative 1% coming into the statistics to a positive 1% all of a sudden coming into the statistics. And that makes a hell of a change.
And Felix is exactly right. These guys, you know, they lie. They change the way they measure it. They do everything they can to make it look good. I'll use the US. The US interest rates and salaries, many interest rates and salaries are tied to inflation. So the government obviously wants to keep inflation down, otherwise they have to pay higher and higher and higher expenses. They have incentive to lie. So they do lie, and they make it all up. And unfortunately, most people don't really pay that much attention. But I'm sure that if you went into your kitchen and looked at the price of, I don't know, a jar of jam that you bought a year ago and went and looked at the jar of jam today at the grocery store, you'd say, oh my gosh, look at this, the prices are up. But most people don't pay attention. They don't have any reason. They don't think about it. But governments have incentive, and they do lie. Plus, just one last aside, brief aside, in the last few years, the price of oil has come down a lot for a variety of reasons. And since oil is the single most important factor in everything, it makes inflation look less bad for the past few years.
I once asked the top central banker why he wants 2% inflation as a target. Why 2%? Why not 0? And he said, and why not the negative 1%? In Switzerland, we had negative inflation for several years. And his answer was, it is easier to distribute wealth when you have 2% inflation than when you have 0% inflation or deflation. It's a political issue. That's what his answer was. And I think he was actually honest on that.
and he was off the record. He would
and he was off the record. Yeah.
He would say. Now, but given the fact that we have government debt levels at the highest since World War II, and given the fact that we are seeing that you are both seeing rising bond yields, don't we get to the question where we have to realize that governments really can't afford to have higher interest rates? And by that, the question that central banks will introduce things like yield curve control, basically trying to control, to limit the rise of bond yields for as long as they can. Is that something that you see coming in the near future?
Well, it's already happened, Mark. I mean, interest rates are the lowest in recorded history. They're going to do their best to keep them down for a long time. But if back to America, I'll use that as the touchstone here. You know, many states and cities in America will go bankrupt once interest rates start rising. Many pension plans in America are underwater. And if we don't, the banks, the central banks, know that if interest rates start going up, Illinois will go bankrupt. Many places will go bankrupt, and they certainly don't want to happen for that to happen on their watch. No, no, no. They don't want problems. Janet Yellen, who was the head of the central bank in America and is now the head of the Treasury in America, has said several times, don't worry. We have figured it out and we have solved the problem and we won't have big economic problems again. Now, if you believe her, Mark, you shouldn't be listening to me. Maybe you listen to Felix. You know, she's got degrees from famous Ivy League universities. Come on. But she doesn't know what she's talking about. None of them do.
Felix, do you expect an outright, an official policy of yield curve control where they put a lid on long-term yields?
At some point, I expect that at some point. We are still far away from that point, but it will come. Once the pressure begins to increase, they will go that step. But that is not the end of the story. The end of the story is when they can't do it anymore. Because just take an example. Let's say the US goes deep into debt and government debt to GDP goes to 200% or whatever. And long bond yields begin to rise because inflation is rising, etc. So if they want to keep bond yields down, that means they have to print a lot of dollars to buy that stuff, you know, to buy the debt. And the printing those dollars will make the dollar go down. And then you have an acceleration of the dollar decline and the serious bear market. And that's when they will eventually lose control of it. That's when it all backfires. And then we have a big mess and a big crisis and a serious recession. And as the price is coming down, etc., etc., that will come, except if they change the rules. If they say we have no free markets anymore, the S&P is frozen, there is no free market anymore, you are not allowed to trade, or whatever. But that is a very different world from where we are today.
Well, Felix made a very important point. There will come a time when the central banks will do everything they can to keep the markets up, etc. There will come a time when the markets say, I don't care. We've seen this before. We know how it ends. We're not going to play your game. And when the markets take control, then it's over for the central banks. And that will not be a lot of fun for most of us.
Now, in the meantime, or let's say in the short term, the dollar has been appreciating in the last 2.5 months. It was really, it hit many market participants on the wrong foot, because late last year, everyone and his dog was bearish the dollar, and now the dollar has been the strong currency this year. How long do you expect this to continue, given the dynamics that we see, both fiscally and monetary in the US? Maybe Jim first and then Felix.
Well, actually, the Chinese currency has been even stronger, but it's a blocked currency, so that's not a good indicator. Well, I own the US dollars. I own a lot of US dollars, not because it's a sound currency, but because when turmoil comes, people look for a safe haven, and many people think the US dollar is a safe haven for historic reasons. I expect the US dollar, when the next turmoil comes, to get overpriced, it could turn into a bubble, at which point I hope I'm smart enough to sell my US dollars, because no central currency has been on top for 100, 150 years. They all lose their status. And the US dollar is already under pressure from many countries for political reasons as well as economic reasons. So the days of the US dollar being on top are certainly not coming to an end this month, but I can see that it's going to happen. But in the meantime, I own a lot of US dollars for the reason I said. But in the end, no currencies lasted forever. And the question that all of us have to do is figure out, okay, what do we do when the US dollar peaks? What do I do when the US dollar peaks and it's time to get out? Where do I go then?
Well, we prepared our subscribers for a better dollar in the first quarter after the slump we have seen from spring 2020 into early this year. So that was no surprise because we saw the extreme one-sided positioning. We expected the widening yield gap in favor of the US. And I also thought that the US-China conflict could intensify. And all of that contributed to a stronger dollar. I think this first shot to the upside as a counter-trend move is over. And we now have a weaker dollar into mid-year. That's what I'm counting on. We have a weaker dollar into mid-year. But I do believe that in the second half, the bond yields in the US will accelerate higher again. And as they accelerate higher again, we have the same game going on again. And I think in the second half, the US dollar will strengthen once again. If we have a nasty correction in the stock market, let's say 10% plus correction in the stock market, that would contribute to risk-off situation. When there is risk-off, the dollar is usually getting stronger because American investors pull part of their foreign investments home, etc. But after that, next year, I think the phase 2 of the secular decline begins, the next second down leg in the dollar bear market. And that should actually be music in the ears of commodity investors, because that would go hand in hand with rising commodity prices.
Allow me an add-on here, Felix. It's a question that we have from the audience. Why should there be a secular bear market in the dollar when pretty much all the other major currencies, at least the euro, the yen, the pound, are basically driven by the same loose policies, where basically they all are driven down? Why should the dollar in this picture be the weakest one?
You have a different starting point. The starting point in China is a current account surplus of chronic fashion. The same is true for the Eurozone. And the US is just on the other side of the equation. They have a chronic current account deficit. And that means that for the dollar to stand still, it has to attract capital inflow of about $500 billion every year just to stand still. And if it cannot attract that inflow, then of course the dollar goes down. That's a result of the trade and current account statistics.
All right.
And Mark, the U.S. is worse than the. Yeah, they're all doing it, but the U.S. is worse. That's the other reason that the U.S. will be under pressure, because we're the largest debtor nation in world history. You know, they're printing money as fast as they can. Many banks are too, but the U.S. is the worst.
Jim, I'd like to hark back on what you said in your introductory remarks. You said bonds are in a bubble, property at many places around the world is in a bubble, stocks forming a bubble here and there, not yet, but you said the cheapest asset out there is commodities. Walk me through your case. Why this current environment that we see and what you said in the last 30 minutes, why is this good for rising commodity prices? Is this mainly an inflation play in your view, or what are the drivers behind it?
Well, to some extent, yes. I'm not the only person in the world who knows that banks are printing gigantic amounts of money. And I'm not the only person who knows that silver's down 50% from its all-time high. Everybody knows Amazon is making all-time highs, but silver's depressed, sugar's depressed. Many things are down a lot. And whether it's inflation or back to silver, are the fundamentals. We're all talking about electric cars now. Well, silver is a great conductor of electricity. Silver, kills germs. If you have worried about germs, if you look at electric cars, an electric car uses 5 times as much copper as a regular car. I mean, there are many fundamental changes taking place in the world, which might drive the price of commodities higher and higher.
We have I'll get to you, Felix, in a second, but we have had over the past, say, 25 years, we've had a huge infrastructure building boom in China. Now, one can say infrastructure in China is world class today, so there won't be that much incremental infrastructure having to be built in China. Isn't that a big source of demand for all kinds of commodities? That is kind of slowing down now, or even breaking away. Felix, how do you see that playing out?
Well, I think here is where China and the US has changed seats. I think in 2008 it was China. That was the big infrastructure push, and that pushed base metal prices in particular much higher. Today, China is going slower. China is much more conservative in its economic policy setting. But it's the US that is going for a big push in alternative energy, green energy, and infrastructure investments, etc. That's the big push. I mean, the budget for the next few years, the program is $4 trillion. And that is, to a large extent, commodity relevant. So it's last time it was China, this time it is the US that is going to be the pushing element in the commodity prices, particularly when it comes to base metals. In agriculturals, it's a different story. In agriculturals, in many of them, you see that the stock or inventory to consumption ratio is very depressed already. And what you have is you have volatile climate. I'm on the other side of the climate people who say it's getting warmer all the time. I think we might be at the change towards a cooler climate. Actually, this month's April so far has been the coolest in Europe in 40 years or so, what I have heard. And I think you have more variation of temperatures, and variation of temperatures is not good for many agricultural commodities. And therefore, we could have disappointing harvests, and therefore you can have higher prices because the demand is relatively stable and the world population keeps growing steadily, but keeps growing. So I think that is the bull case for commodities. If you add sanctions coming and blockages in a Cold War that intensifies, you could lose deliveries and things like that. And this is also an element that should put the premium on commodities that have to be shipped from one place to the other, that are in the midst of this Cold War period. So I think these elements are really favoring higher commodity prices over the next few years.
Jim, you mentioned when talking about commodities, you mentioned silver, you mentioned sugar. In the broad commodity field, which ones, apart from those that you mentioned, which ones do you particularly like today?
Well, I also mentioned oil, which is down 50% from its all-time high. You know, we had a big collapse in the price of oil because of fracking. Well, the fracking bubble has popped. You know, for a while there, if you could spell fracking, people would give you a check. They'd give you money. But now they realize, oh, they have to pay their bills. Fracking, they don't make money. So that's changing. And in the meantime, the known reserves of oil and natural gas continue to decline. Fracking is not going away, definitely, but the huge bubble that existed in fracking has come to an end. But which commodities? Agriculture. I mean, pick an agriculture. I bought more of an index, agricultural index today, as a matter of fact, and will be buying more. You know, agriculture has been a disaster. The average age of farmers in America is 58. The average age in Japan is 66. The highest rate of suicide in the UK is in agriculture. I mean, I can go on. More people in America study public relations than study agriculture. I mean, I doubt if you know many people that can drive a tractor, even in agricultural Switzerland. So no, I would suspect that it's supply and demand that are going to change, continue to change in agriculture, but everything. Back to oil, yes, oil prices are down a lot. In my view, oil prices are making a complicated bottom. We'll look back in 3 or 4 years and say, oh my gosh, look at that bottom. But likewise, metals, I told you that copper, an electric car uses 5 times as much copper as a regular car. All of these things that are taking place in supply and demand, and that normally leads to bull markets.
Now, within the commodity field, obviously, there's a special sector for gold, precious metals. Now, in this environment of a rising dollar and rising bond yields, also real yields, gold has been kind of dead in the water in the past few months. What is your expectation on how the gold price will perform over the shorter and then also the longer term going forward? Jim first.
Well, I own some gold too. You need a little gold. I've got some right here. You never know when you might need some gold. You said gold. I mean, gold is up a lot since 2019. Yes, it's been consolidating. My plan is to buy more silver and more gold after this consolidation. Now, I'm bad at market timing, but I can see them both consolidating. I'll probably buy more silver than gold, because gold on a historic basis is much more expensive than silver, but I'll probably buy both going forward. Throughout history, when things go wrong with currencies, governments, whatever, people, all of us peasants, buy gold and silver. Now, the academics and the politicians say, no, forget gold, forget silver. But Mark, I'm an old peasant, and all of us old peasants know that when things go wrong, we want some gold in the closet. We want some silver under the bed. And I will buy more silver and gold because I know things are going to get really bad sometime in the next few years, and all of us peasants are going to be buying more gold and more silver.
Judging from that, I get to you, Felix, in a second, but judging from that, I reckon you're not a big fan of Bitcoin?
No, I have never bought nor sold. I mean, obviously, I wish I'd bought a lot of Bitcoin at $5 or whatever. Anything that goes up, I wish I'd bought a lot of it. My money is going to be on the computer. It already is in China. If you go to China, you cannot take a taxi with money. It's Chinese money. You have to have it on your phone or ice cream, anything. China's way ahead of the rest of the world, but the US and every other country is working on computer money. All money is going to be on the computer eventually, but it's going to be government money, Mark. If cryptocurrencies become serious currencies and threats to governments, history shows governments are going to say, wait a minute, you can't use that stuff. You got to use our money. You have to use government money, and they'll outlaw it. At least they always have. Governments do not like to lose control. I mean, I don't particularly like it, but governments do. And history shows that they will outlaw it. Now, that doesn't mean you can't trade it. A lot of people have made a lot of money and are making a lot of money as a trading vehicle. I'm not a trader. I'm not any good at trading, so I'm not doing it.
Now, Felix, on the topic of gold, you recently wrote that you expect an important short-term low within the foreseeable future. What's your view today? When is the right time to buy gold from a trading
Well,
perspective?
we received a sell signal, a long-term sell signal last August, and I have been saying since that this year or for 12 months at least, gold will be dead money, and I think it has a lot to do with rising bond yields, etc., etc. Even if they are very low and real yields are negative, but the trend is wrong. And I think that when I look at the statistics, that the physical demand out of China and India is weak and will probably stay weak for this year. So I still believe gold is in a transition period, transition to the next bull cycle, and that could last into later this year or so. The next impulse, really impulsive rally that should be powerful, I expect when the dollar starts its next down leg. In the meantime, gold is a trading vehicle. I expected in my last report I wrote, I expected an important low coming up within the next 3 to 6 weeks. We have seen 0% bulls for over 2 weeks in the surveys. You have to go back 7 years until you get that number at much lower prices. So the market is extremely bearish positioned, and therefore I think the technicals really called for a rally, some response to the upside, and with the first up leg in the counter trend move of the dollar ending, that goes coincident with the down leg ending in gold, and therefore you have a move down into mid-year now in the dollar and a move up in the gold price. I think this is trading. This is maybe a 10% move or something like that. I do not believe we will see new highs on this rally next year. I think we are back to the bull cycle again. Yes.
But
You see,
both of you,
Mark, I told you everything I know I learned from Felix.
how do both of you see mining stocks, both silver miners and gold miners? Obviously, they've had a bit of a rough patch as well in the past few months, but one can say they are really cheap on a fundamental level. How do you see them, Felix, first?
Well, they are cheap, and gold mining companies have been managed very poorly for many years, and that has changed for the better in the last 2 years or so, the last 2-3 years or so. So I think they are now much more efficiently run, and therefore the gold miner should perform better than gold until the next rally starts in gold. And I believe that the gold mining stocks, they are cheap and they are like a long-term unexpiring option on gold, on the gold price, because they own a lot of gold that is still in the ground, and they produce gold on the surface to create the cash flow. And at the top of the next gold boom, at the top, they will value all the gold in the ground, and then you will have a very high price. So I think I would recommend for those people who like gold to buy some mining stocks, put it on the side, and I think when the gold price flies again from next year on, you will be very happy about this.
Jim, is that something you invest in, gold miners?
Well, I own a couple. No, the answer is not really, although I do own a couple. The problem for me, first of all, I'm lazy, and Mark, there are hundreds, if not thousands, of gold and silver mines in the world now. And there was a famous American writer once named Mark Twain, and he said, the definition of a gold mine is a hole in the ground with a liar standing at the top. He lost a lot of money in a gold mine. And if you know, Mark, if you know a company which is going to find gold in Berlin, you should buy all you can. And then you send me an email because I want to buy some too. But the problem is there are thousands of these things. And I do not know which ones to buy because I'm too lazy. But Felix probably knows. You buy the right gold and silver. As I say, if you buy the right stocks, you'll make a fortune. They'll be even better than buying gold futures, but you got to get the right one, or you'll be like Mark Twain.
Okay, that's a pitch to you, Felix. Which are the right ones?
Oh, I'm lazy also on the micro side. I'm not lazy on the macro side, but on the micro side, I rely on people I know, I trust, and obviously you start with the big ones, the Newmonts, and then you go down the Nico Eagle and the Alamos and those type of guys. I wouldn't go to the juniors because I do not know them. And I keep in mind what Jim just told me, that there is usually a hole and a liar on top of it.
We have to come to an end, unfortunately, but I'd like to hear from each of you, and that's a question that has been asked in the audience as well. If I wrap up just quickly, you both see a return of inflation. You both say bonds will do not good in this environment. Obviously, you see rising bond yields, so hands off bonds. Stocks, Jim, you say they are forming a bubble, not quite there yet. Felix, you say we probably will see a correction sometimes this year, but you also see a continuation of the bull market in stocks, and you both are quite bullish on commodities. Now, my question is, and the question from the audience is, looking at this unfolding over the next few years, also seeing the monetary policy, the fiscal policy, return of inflation and so on, how will the end game kind of look like? Because we kind of sense that we're at the end of an era and the beginning of a new era. How will the end game play out, and how can I, as an investor, how do I have to construct my portfolio to perform well in this time of turmoil? Would you like to go first, Felix, and then we give the last word to Jim?
Okay, I think you have still be overweight in equities, because I do not see a big crash or anything like that. They will try to keep the markets up. There will probably be a lot of rotation, because rising bond yields and the rising risk premium due to an intensifying Cold War will be heavy on the valuation. So you will have a lot of rotation, and you have to be very flexible. Right now, I think there is still more outperformance by cyclical and value stocks over growth, although that may not be the case over the next 3 weeks or so. But longer term into next year, I think cyclicals and value stocks will do better. You need some precious metals as a hedge, because we live in a fiat currency world. You need some commodities, of course, and I would spread commodities and buy some good ETF indices. If you go for one particular commodity that is left behind, I would go for coffee. Coffee is still far down, and the harvests look disappointing. And I think next year we will have a shortage in coffee. And usually when you have a shortage, the price goes up 100 to 200% or so. I would not be in bonds. I would have some cash on the side, because when there are shakeouts, there are always opportunities. Basically, you have to change from a passive investor to a very active investor and very opportunistic investor, because I think the upside will be limited and there will be a lot of rotation over the next few years. So you have to be very opportunistic. You cannot go on autopilot.
All right, thank you, Felix. Jim.
Well, I mentioned before that I bought more agricultural commodities today, the index, that is, stocks. I mean, Russia, Japan, these are markets that are depressed, and certainly Russia's hated. I bought more China. All of these markets are depressed. The American stock market's making all-time highs. I still own shares and will buy more. I mentioned you. I mean, the Bank of Japan prints money every day and buys ETFs. The Bank of Japan has more money than I do, Mark, so I buy Japanese ETFs as well. And Russian shipping, I mean, there are various and sundry things that are still cheap around the world, and I bought more of those, but especially commodities. I am shifting more and more to agricultural commodities, but to other commodities as well, because as I said in the beginning, this is the cheapest asset class I can find around the world.
Right, we have to take that as a closing statement. My apologies that I wasn't able to take all the questions from the audience, but I think I've covered most of them. Felix, by the way, there was one question asking whether you could explain your cycle theory a bit more in depth, but I reckon that would take a bit more time. So I suggest maybe that's a one-on-one with that client from you.
But wait, if you have a few seconds, I'd love to hear it myself. I have a few seconds.
There are all sorts of cycles. There are economic cycles, of course, and there are trading cycles, and you have to know what it is, and you check those cycles and where you stand based on the cycles, and you compare it to the markets, and that tells you whether it's 9 o'clock or 12 o'clock or 3 o'clock or whatever. So you have to know what time it is in your cycle. And obviously early in the cycle, you can take a lot of risk, and late in the cycle, you rather reduce risk. But there are many, you know, there is the kitchen wave, which is the inventory cycle. There is the Kuznets, which is more real estate. And then there is the infrastructure cycle, and there is the Kondratiev cycle, and then there are the Benner cycles, which is a family of the Kondratiev cycles, etc., etc. It's a very intense topic, and cycles have the habit of not showing up when you really need them, and therefore you cannot build and form a policy based on cycles alone. But cycles as an add-on may give you safety at the right time, and when you want to shoot sharp, be it on the upside or on the downside.
All right.
It's art. It's not science. It's art.
All right. Well, thank you very much, Felix. Thank you very much again, Jim, for joining us. And with that, thank you all in the audience for being with us. I wish you a great day wherever you are, whether in Singapore, somewhere in Europe, somewhere in Asia, or over in the Americas. Have a great day. Stay safe, stay sane, and take care. Goodbye.